Hey everyone, welcome back to the channel. If you're new here, this is Options Over Ordinary, and today we're diving into the basics of options trading. Whether you're looking to diversify your investment portfolio or just curious about how options work, this video will give you a solid foundation. So let's get started. First things first, what exactly are options? In the simplest terms, an option is a financial contract that gives the buyer the right, but not the obligation, to buy or sell an asset at a specific price before a specific date. The two main types of options are call options and put options. A call option gives you the right to buy an asset at a certain price, while a put option gives you the right to sell an asset at a certain price. It's important to remember that buying an option doesn't mean you have to exercise it. It's all about having the option to do so. To get a better understanding, let's go over some key terms you'll encounter in options trading. Strike price. This is the price at which the underlying asset can be bought or sold when the option is exercised. The strike price is a critical component as it determines the point at which an option becomes profitable. For example, if you have a call option with a strike price of $50, you can buy the asset at $50 regardless of its current market price. Expiration date. This is the last date on which the option can be exercised. Options have a limited lifespan, and this date signifies when the option contract expires. After the expiration date, the option becomes worthless. It's crucial to manage and monitor the expiration dates to ensure you make the right trading decisions within the given time frame. The premium is the price you pay to purchase the option. It's essentially the cost of buying the option contract. The premium is determined by several factors, including the current price of the underlying asset, the strike price, the time until expiration, and market volatility. The underlying asset is the financial asset that the option contract is based on, like stocks, bonds, or ETFs. The performance of this asset influences the value of the option. For instance, if you have an option on a stock, the movements in the stock's price directly affect the option's price. Now let's talk about how we view the option. In the money, for a call option, this means that the stock price is above the strike price. For a put option, it means the stock price is below the strike price. Being in the money indicates that the option currently holds intrinsic value and can be exercised for a profit. On the other hand, out of the money is when, for a call option, the stock price is below the strike price. And for a put option, it means the stock price is above the strike price. Out of the money means that you have no intrinsic value and they're generally not exercised because it would result in a loss. We'll talk more about in the money and out of the money in future videos and what it means to specific trades. At the money means that the stock price is equal to the strike price. At the money options are at the point when the option strike price is equal to the market price of the underlying asset, making it neither profitable nor unprofitable. Understanding these key terms is crucial as they form the foundation of options trading. For example, if you buy a call option with a strike price of $50, you have the right to buy the underlying asset at $50 before the option expires. Now let's talk more about how options work. When you buy an option, you're purchasing a contract that gives you the right to buy or sell an asset at a specified price. Here's a simple scenario. Imagine you buy a call option for Company X with a strike price of $50 and you pay a premium of $5. If the stock price of Company X rises to $60, you can exercise your option to buy the stock at $50 and then sell it at $60, making a profit. However, if the stock price stays below $50, you'll probably choose not to exercise the option, and then your only loss is the premium that you've paid. Let's take a look at a put option now. Suppose you buy a put option for Company Y with a strike price of $40 and you pay a premium of $3. If the stock price of Company Y falls to $30, you can exercise your option to sell the stock at $40, which would be beneficial if you own the stock and want to avoid further losses. If the stock price stays above $40, you might let the option expire and your loss is limited to the premium. Options trading comes with its own sets of benefits and risk. Let's start with the benefits. First is leverage. Options allow you to control a large amount of an asset with a relatively small investment. This means you can potentially generate significant returns without needing a large amount of capital up front. Second is flexibility. Options can be used in various strategies to hedge against potential losses or to speculate on price movements. For example, if you own a stock and are worried about a short-term decline in its price, you can buy a put option to protect your investment. And finally, for buyers, there's limited risk. When you buy an option, the maximum risk is limited to the premium you paid. It's different from other types of investments where potential losses can be much higher. It's important to note, though, that there are also risks. First, complexity. Options can be complex and require a good understanding of how they work. This complexity can be daunting for beginners and requires a commitment to learning. You want to make sure that you're comfortable with understanding how options work before trading. Second is time decay. The value of an option decreases as it approaches expiration date. This is known as time decay, and it means that the longer you hold on to an option without it moving in your favor, the more value it loses because the less time you have in the market. Third, potential for significant losses. Especially if you're writing options, the potential for losses can be substantial. Writing options or selling option contracts can expose you to unlimited losses if the market moves against you. Now let's go over a few basic strategies you need to get started. First is long call. Buying a call option when you expect the price to rise. This strategy allows you to benefit from a rising market with limited risk. Second is long put. Buying a put option when you expect the price to fall. This strategy is useful for profiting from declining markets or protecting existing investments because it allows you to put the stock at a specific price. If you expect it to fall, then you have the option of putting the stock at a price that you expect to be higher than where the market is going. Third is covered call. Owning the underlying stock and selling a call option to generate income. This strategy can provide additional income from the premiums received for selling the call options. It's also an important part of the wheel strategy, which we'll talk more about in another video. Finally, protective put. Buying a put option to protect against a decline in the stock price of a stock you own. This acts as an insurance policy for your investments, limiting potential losses. These strategies can help you understand how to use different options in different market conditions for various investment goals. So if you're ready to start trading options, there's a few more steps to get you going. First is education. Invest time in learning about options. There's plenty of online courses and free resources, books, and many other items available. Make use of these to build a solid understanding. 2, choose a broker. Find a brokerage that offers options trading. Make sure to compare fees, tools, support, and also requirements to get into options trading. Look for a broker with a robust platform that provides comprehensive tools and resources. There are many options out there. Make sure you understand what each broker is offering and what the requirements are for trading. Third is practice. Many brokers offer paper trading accounts where you can practice without risking real money. It's a great way to gain experience and confidence before trading with real money. And finally, when you do start trading with real money, make sure you start small. Begin with a few basic trades and gradually increase your activity as you become more comfortable. It's important to start small and learn from your initial trades. You can continue to evolve your trading strategies. Options trading can be a powerful tool in your investment arsenal, offering flexibility and potential for profit. However, it's essential to understand the risks and start with a solid foundation of knowledge. Thanks for joining me today. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more financial tips and strategies. We are just getting started on options over ordinary. Until next time, happy trading.